Great. So what I'm doing is, and I did it the same way last time, I have a little presentation where I basically talk about the basic ideas in the paper. I think it's a really, really interesting one. It's called 101 Formulaic Alphas. If you have any questions, please come in. So last time we did quite a heavy subject on the mathematical side, called the virtue of complexity. And interestingly, the paper today ties in with that a little bit. It's almost like it gives you a basic understanding of what was actually discussed there. I hope you find it really interesting, because what it also does today, so it's a bit more, a bit less advanced, bit more basic, but nevertheless pretty complex. And it gives you a really good insight into quant thinking and how professional quants think about trading in general. And I hope you find it really interesting. Okay, so basically the paper is made some big waves actually when it came out. It's called 101 Formulaic Alphas. And when I saw it first, I was quite intrigued in what's in there, because these are some guys from World Quant, which is a big systematic trading firm. And they basically published some of their quantitative formulas. And that's quite a big thing, because usually firms don't really do that. And so it was super interesting and intriguing, made a lot of waves. I want to explain to you a little bit what this paper is about, and how to understand what's in there. Because one thing I found was that a lot of people didn't quite, they look at these formulas and they're like, yeah, I get it, but I don't quite understand how this works. So I want to talk about this a little bit today. And here's the link again. So if you haven't got it yet, that's the link to the paper, but it's also in the message box. Now, the gist of the paper is, and this is just what's written in the abstract, we present explicit formulas that are also computer code for 101 real-life quantitative trading alphas. The average holding period ranges from 0.6 to 6.4 days, so it's what you would probably call mid-frequency. And the average pairwise correlation of these alphas is low, 15.9%. So they're all like very different alphas, and quite complex ones for that matter. Now, initially, when people read this, what they started to do is go crazy. And I was one of them, and just replicate these alphas and basically trying to write code and see whether any of them is actually really good. Now, in my opinion, moving on a few years from when the paper came out, I think this was a bit of a quote unquote foolish idea. Not foolish, but not necessarily the way it was intended. And I want to talk to you a little bit about why I think that is the case, but also what we can learn from the people actually publishing these alphas, which I think is super fascinating. So first of all, for many people who haven't actually been in the quant space, or even have been traders, but not necessarily in the professional quant space, they may not be aware of what an alpha actually is. So I want to just quickly touch on that, because I think this is important to understand before we move on. Now, an alpha is basically a trading signal. So let's just, for simplicity, say we have an RSI, a technical indicator. And so what is the alpha? The alpha is effectively, we apply this technical indicator to current stock returns. So it means the price today minus the price yesterday divided by the price yesterday. So we either apply it to that, or we can also apply it to today's prices. So we may have open, high, low, close prices. We may have volume and so on. And so we actually take the signal, apply it to stock returns. So I should have actually put all this other stuff in here as well. not just stock returns, but open, high, low, close, volume, all that. And so, for example, if we use an RSI, all we need is the close price of today, and then we apply that, and we, or the close prices of a recent period, we apply that, and then we get a certain value. And now, what the alpha actually is really a predictive model of future asset returns. So, well, in the case of the RSI, we get a value out of it, and its value is supposed to tell us something about what we expect the return to be in the next period. So, in simple terms, prices going up or the prices going down. That's it. And when we do this, what we're really doing is we're applying this equation of this trading signal, in this case an RSI, to the current return, and then correlate that with the return of the next period, which is basically saying, okay, we have the value today, and then hopefully that has some correlation to the return tomorrow. So meaning if the value, for example, is low in the case of the RSI, we get a price increase because it's oversold, and if the value is really high, then we get a price decrease in the next period because it's overbought. All right. So again, if you have questions, please feel free to jump in and ask. So the alpha, I said, is then the correlation between the value that we get from this formulation and the forward return. So the return of the next period, meaning the value today correlated with a price change, say from today till tomorrow, or the value from this week correlated with a price change from next week. Okay, so this is how we test it. And the amount of correlation that we see, so basically the slope of that correlation, then tells us something about how strong is this alpha, or how predictive is this alpha. And this value, you know, this can just be calculated simply by doing a normal linear regression, but we can also calculate it by using something called a Spearman rank correlation, which is, instead of using the total values, you actually use the ranks of these values and then do a correlation. And so it depends case by case on what. But what's important here is we actually want to define how predictive is our signal. Now, this brings me to something that is really, really important to understand here. And this is also why, this is also the underlying principle of this paper, even though it's not explicitly stated. And that's the fundamental law of active management. And so if you have never heard of it, it's in a book by guys called Grinold and Kahn, and it's called, I think it's called Active Portfolio Management. And it's, I sometimes call it the Bible. It's a really, really important work in quantitative trading. And so if you haven't seen it, it's highly mathematical, and it's around 700 pages. So it's quite a heavy read, but it's really an important work. Now, the fundamental law basically says this: IR, which is the information ratio, equals the information coefficient times the square root of breadth times the transmission coefficient. So the transmission coefficient is effectively trading costs included. So I'm gonna leave this out for now. In fact, in the original work by Grinold and Kahn, they didn't include the transmission coefficient. And it's not really that important right now for what we're trying to talk about. However, what is important is this: it's the information coefficient. So what is the information coefficient? The information coefficient effectively reflects the skill of the trader. And the information ratio, for those of you who are not familiar with, that means it's actually more or less a proxy for the Sharpe ratio. So Sharpe ratio, of course, is the risk-adjusted return, or the average returns of your strategy divided by the standard deviation of the returns. So the Sharpe ratio of our trading system, whatever it may be, is a product of the skill of the trader times the square root of the breadth. And the breadth is an interesting one, because breadth means that we're effectively having either a diversity or how do I say, a breadth in time, or a breadth in the types of assets or strategies or whatever we trade. So let's just say high frequency traders, they usually have a very, very low skill and information coefficient in their types of trading, but their breadth is incredible because they trade several hundred times a second, and or whatever, trade a lot. And so usually high frequency traders achieve incredibly high Sharpe ratios or information ratios because they have a really, really huge breadth in time. Now, the other thing we could do is, instead of just trading one or two assets, we could trade, let's say, the complete S&P 500. And that gives us a large amount of breadth as well. The other thing we can also do in order to increase our breadth is trade a lot of different trading strategies. And this is where these formulaic alphas come in, because what they all really signify is different trading strategies. So just one more word before I keep going is this IC here, the information coefficient. Basically, in a numerical sense, what the information coefficient is the actual correlation between your alpha or your trading signal and your forward return. So if this is 1, you basically have, you're an insider trader, or you do perfect arbitrage or something like this. So so that's rarely ever the case. But usually these correlations are quite spurious. And as a ballpark, in professional trading, a correlation of 0.025 is already reasonably acceptable as a benchmark for trading, or as a sort of some trading signal that you would like to include in your system. So these correlations are usually extremely small, but effectively what they tell you is, okay, this is the skill of the trader in this particular strategy. And then, of course, we're quantitative traders, so the other opposite end of the spectrum is, say, Warren Buffett, who is extremely skillful in picking stocks, and his breadth is extremely small. So it's only, usually a few stocks, maybe in the tens or so, and but his information coefficient is extremely high. While for quantitative traders, it's usually the opposite. They have a lower information coefficient and a higher breadth. And yeah, as I said before, the breadth can be achieved through various ways. One is through just using different products that you trade. Another one is using different trading strategies. So here, another quote from the paper, and it talks about these alphas and how alphas are used nowadays in trading strategies. It says, this proliferation of alphas, albeit mostly faint and ephemeral, allows combining them in a sophisticated fashion to arrive at a unified mega alpha. It is then this mega alpha that is actually traded, as opposed to trading individual alphas. So what we're doing is really, we increase the breadth here by trading these ephemeral alphas, which have a low IC, but your breadth is really large. And instead of actually trading them all individually, what we do is we combine them mathematically, effectively, in the simplest case, just adding them up, and then trading this, and this will hopefully also improve the performance, so the Sharpe ratio of our strategy. And so the intention of the paper is really to show, okay, this is the types of alphas or things we can actually trade or we can do in order to build trading strategies that are fairly successful.
Hey, Tom, I just wanted to let you know we have a question in the chat.
Sure, go for it.
Jacob, do you want to chime in, or I can read this off for you?
Oh, okay. Hold on.
I can read it. Can you guys hear me?
Yeah, go for it.
All right, perfect.
Is it Jacob?
This is a perfect slide. This is the question I have. Is mega alpha basically just like a when you say combining little alphas? Is that just like a multi-strat fund, like combining different strategies, or is you combine little alphas into one strategy?
Well,
How do you think that?
it's actually mathematically speaking, it's actually the same thing. So if you have a big fund and you have lots of traders there with different alphas and you run them in a fund, that's effectively the same as you on your laptop or whatever, combining small alphas into a combined strategy. So both are really equivalent and they can be treated as equivalent. Now, obviously the difference is in, let's say, a larger prop trading firm or a fund, that when you have all those different, say, trading teams, and they're all obviously trading their own things. But let's just say in the case of World Quant, they actually have all sorts of individual traders across the world. And what they do is they basically get their signals and then they transmute them or transform them, put them into some sort of through a testing stage, and then effectively trade those signals as one combined big alpha. Does that make sense, Jacob?
Yeah, no, it makes sense. Thank you again. Thanks again for hosting this.
Sure, no troubles. So yeah, so we're basically taking those and combining them. And so what I want to do is just jump straight in, because I talked a lot about the law of asset management and what an alpha is, but what does it actually look like? And so if you actually go down in the paper to the first appendix, you can see that there is all these really mysterious looking formulas, which are effectively what these alphas mean. And so here I just picked one, which is the alpha number 16, and it says -1 times rank, covariance, rank high, rank volume 5. So what does this really do? And so what we're doing here, or what we have a few assumptions in this equation. And the first one is that we have a set, or we have a portfolio. So let's just say we have a portfolio of 500 stocks. Let's just say the S&P 500. Each one of those has a time series attached to it, or price series. And so we can look at this in different ways. We can look at it in one way, or in one direction, where we can look along the time axis, but we can also look at this basically array of numbers along the axis of assets. And so when they say rank here, what they're actually meaning is the rank along the assets axis of assets. So here we have a rank of all the high prices. So basically what this does is it ranks all the high prices of each asset from the lowest to the highest. So each one of them gets assigned a number. And the same is true for the volume. So each one of them gets a rank according to their volume. And now then, for each time step, these ranks will obviously change a bit. So the volumes will change, the high prices will change, and so on. So the ranks will change in that. Now what we do is, with these ranks, we're actually taking 5 steps, or 5 time steps, and then we calculate the covariance between those two ranks. So this is effectively saying, okay, how correlated are they, if you will. So we look at the variance or the covariance between those, and if you haven't looked at the concept of covariance yet, it's basically it's fairly straightforward linear algebra. So have a look. And what we do get here is basically a number. Normally what we do is we can create a variance covariance matrix, which which basically gives us the variances on the diagonal and the covariances at the off diagonal. And because it's symmetrical, usually what we do is we just use one of the off diagonal values to get the covariance. And then, interestingly, what we do is once we get these values, we rank that again from the lowest to the highest. And that's our trading signal. Now, in this case, there is an additional step here. It's this -1. And so normally what this denotes is a +1 basically means we have a strategy that is more of a trending strategy. And when we have a -1, it's actually a mean reverting strategy. So what this means is if this rank is really low, then we would basically go long. If this rank is really high, then we would go short. So, or if this value that we calculated here is high, we go short. If this value calculated here is low, we would go long. So that's effectively how this works. And what you can do is you can actually turn this into computer code. So you have like these little snippets here. You have these little atomic values that are ranks and so on. And then you can actually take those and put them in computer code, and then you can calculate it. And so this equation, looking quite small and innocent, actually really applies to this huge matrix of like hundreds of stocks, for example, and then let's say 5,000 different time steps or so.
Hey,
So,
excuse me, Tom, we have another question, and I'm not
sure,
sure if
go
this is initials or first name. I guess first name, but on. Do you want to share your question?
Hi, Ian. Oh, I can see it here. Do these alphas have economic underpinnings, or are these formulas that seem to have historic positive expected returns, but with the risks diversified away? Okay, that's a really good question. Now, if you actually look into the paper and you look through these alphas, what you can see is that they're effectively just mathematical formulas. And so I would say, I can't say this for sure, these none of these equations actually has economic underpinnings. So what is with these equations, they have so you can build a computer model or a computer program that in according to some rules, let's say, and that's usually how this works. So really, they're not economic formulas in any way, in my opinion, in this paper at least. And yeah, they're purely mathematical. Now, there's obviously people arguing, well, if it hasn't got an economic reasoning behind it, why would you use it? And that's a very fair point. And the reason probably why you would use it has in some sense been answered in the previous paper discussion, The Virtue of Complexity. If you haven't looked at that, I highly recommend checking that out, because basically what these guys argue is that if you have many, let's say thousands or hundreds thousand or millions of these spurious alpha signals, you can actually plug them into some AI algorithm and then produce trading strategies that are better than what you would expect usually from a small number of predictive signals. So here we go. There is some interesting connection to our last talk. Now, there is another equation here that I would like to show you. Now, this is alpha 100, and so you can see that it looks so complex that I definitely could not tell you even remotely what this is meant to do. The previous one was already a little bit complex. This one is way too complex to even start to understand it. But one of the things that here is interesting, for example, they have a time series arc min. So it basically means let's look at the last 30 close prices along the time axis and then see which one of these close prices is the lowest. And then the number of that, let's say the 16th of these 30 is the lowest close price. And so it gives us the number 16, and then we create a rank across all the different assets that we trade, and that gives us this expression, for example. Here we've got a correlation as well. For example, the correlation of the close price and the rank of the average daily volume over the last 20 days. There's also some other things like fundamental stuff, like the class of the sub-industry that usually is a number. So it's like some sort of label for an industry. You also got this thing called neutralize. So it neutralizes industry correlations. So if we have say an tech industry or tech sector here, what it does is it basically takes out the beta of your price series with the tech sector, so that only the alpha is left. Now, one of the reasons why I think a lot of this is computer generated, or this is all computer generated, is that some of it doesn't necessarily make sense if you would write it down explicitly. So for example, this here 0 minus this, a normal person wouldn't write it down like that. You would put in the minus, but you wouldn't necessarily include the 0. And that seems to be pretty obvious that only a computer would generate this sort of thing. And then here again, we've got these int neutralize expressions here that they're nested twice and another time down here. So it seems like someone that actually sits there and comes up with alphas wouldn't necessarily do it that way. And to me, this is a very good example of why I think this is computer generated and not necessarily have, as the question before, any economic underpinnings. So I have actually done some of this myself. So for example, this is a typical example of one of my own alphas here. It looks a little bit different than what's in the paper, because I'm using a few other functions as well. So I use some technical indicators here, like let's say balance of power and a VWAP. And then, I create these formulas and get some, just get some alternative results to what this is doing. So what are the results? So the paper talks quite extensively about the Sharpe ratios and the performance of these alphas. And I think what they have actually done is they have actually handpicked alphas that do have some that show some decent performance. So it looks to me, from when I read the paper, that the alphas that they showed, they were alphas that at least at the time did show some promise. And they actually state in the paper explicitly that 80 of these 101 alphas are used in production. But the issue is, you don't know what particular assets they trade. We don't know what time frames they trade or anything like that. So it's in some ways good to know that these alphas are traded, but they are more or less useless because we don't really know how we would trade them. Now, there's some people that.
Hey Tom, we have another question on the prior slide. Benjamin, you want to
hey guys,
chime
why
in?
don't you just jump in? Why don't you just jump in and ask these questions directly? That makes it easier for me.
Very helpful.
Yeah.
What is the balance of power that you mentioned in the previous slide?
Balance of power is just a technical indicator. You can actually get it from TALib. So if you
Thanks.
want to do it, it's nothing very complex. It's just one of these TALib indicators. And I thought, well, may as well include a few of those. In some sense, you can throw in a lot of things like fundamental data as well. So you could use balance sheet stuff and whatever. Like there's no real limits to what you could throw into these alphas. And yeah, it's just really up to your own creativity and also in a sense to your trading horizon, to all the things that you want to do. That makes all the difference when you do these. So I actually right at the end of my talk, I actually leave you with there's code on GitHub where someone coded up all these 101 alphas. So you can actually see it here. There's a link for anyone who's interested. If you just Google it, 101 alphas, GitHub, you see it as well. So if you're interested in how this is coded up, you can actually see it there. Now, as I said, I don't believe that these alphas presented there have explicit value as such. And I think they stated in the paper as well, they say, well, this is more as thought of as an example of what people are doing and how you could do it as an inspiration for people to do something similar and to learn something about it. And I think I agree with that. That's really what the paper is about. So if you want to sit down, code them all up and run them, you may not find that many of them actually do have a really good return performance after all. And that's really not the point of the paper. So what results do they get? So they don't really say. So the paper is actually fairly short in the amount of information that they present, other than these alphas. And one thing they say is, well, there is actually a strong correlation between the volatility and the alpha returns. So if you have a high volatility, you get alpha returns. In some ways, that's pretty. It's pretty self-explanatory, I would say. Like it's kind of obvious that this is what you would expect. At the same time, there's a footnote, and it says suppressing alpha weights by the turnover can add value, but be highly correlated with volatility suppression. So if you're not familiar with the idea of turnover, when you have alpha signals, basically each number tells you how strongly you should weight your portfolio towards that alpha signal. So if you have a really high value, the weight of the asset in your portfolio should be much larger. And if the value is really low, maybe you go strongly short and so on. And so what happens is when you actually go to real life trading, if the values fluctuate massively from positive to negative all the time, then you get a massive turnover. It means your strategy trades a lot. And that, of course, has an adverse effect on your trading costs. So you might have a perfectly good alpha producing strategy, but if it fluctuates a lot, you get killed by the trading costs, which really is a no-brainer. I mean, that's what what you would expect. And so one of the things that you need to really take care of is the turnover in your strategy, and you want to try to keep that as low as possible. And so what they say here is we can suppress alpha weights by the turnover, which means if the turnover in your alpha is pretty high, then we basically want to suppress the weight of this alpha, meaning that when we add all these alphas together, instead of adding them just like in a sort of naive way, just summing them up or averaging them out, we actually weight them in some way. And one way of weighting them is to actually include the turnover, because if you have a high turnover, we want to weight those strategies lower, because usually they just end up producing a lot of trading costs for us. And so it's not necessarily a good thing. And they say, well, this is also highly correlated with volatility suppression. Now the other thing is that when you get these strategies, normally what you do is you look at the volatility of each of those alpha or not the alpha signals, but the alpha returns. And usually what you also do is an inverse volatility weighting. So you divide these signals by the volatility of the alpha returns, so that each of these alphas has more or less the same volatility. Of course, you could do something like a mean variance optimization on your alphas as well. So it's like a Markowitz portfolio weighting that would work. Usually, just aligning the volatilities of your alphas is often already a good thing. So you basically have a risk parity between all the different components that are included in your alpha. So they're basically referring to, in a nutshell, to different ways you can weight all those different trading strategies in your portfolio. And that's obviously important, because some trading strategies, there are in quote unquote better, and some are not quite so good. And you want to make sure that you weight the ones that are quote unquote better higher than the ones that are not quite as useful, which is clearly a good thing to do. All right, so what are the conclusions of the paper? They say we emphasize that the 101 alphas we present are not toy alphas, but real life trading alphas used in production. So they say 80 of these alphas are in production as of the time of writing, but they actually also say in a footnote that they can't explicitly state which of them are because of proprietary concerns. To our knowledge, this is the first time such a large number of real-life explicit formulaic alphas appear in the literature. So that's true. So no one's ever actually published alphas like that in the literature. Now, I mean, they probably, given the fact that they were probably computer generated, they probably have millions of them at their disposal. One of the really hard parts is to then make a selection of these alphas, because one thing that happens is if you take some sort of optimization engine also and you say, well, we've got our alphas and we weight them in sample, usually what happens is we end up with a perfect correlation, so with like an R square of 1 effectively, and so we would, we would clearly call that overfitting, and that's, despite of, and that would never work out of sample. You can actually see that when you combine the alphas in a specific way and then they all fit perfectly, you see that in sample they have a perfectly straight line from the bottom left to the top right, and then as soon as you go out of sample it just goes flat. And that's a typical example. So you need to figure out a way to actually make selections, and that is generally the tricky part. And that's obviously not what, none of this has been stated in this paper, so they don't actually tell you what sort of selection you can make. And again, that's obviously also down to the traders. What do we want? So another conclusion which I found very interesting is technological advances nowadays allow automation of alpha mining. So that's effectively what they've been doing. They automated the whole process. Quantitative trading alphas are by far the most numerous of available trading signals that can be turned into trading strategies and portfolios. So they are non-economic mathematical alpha signals, completely computer generated and tested by an automated system. There are a myriad of permutations of individual stock holdings in a portfolio, for example, 2,000 most liquid US stocks that can result in a positive return on high and mid-frequency time horizons. So in some way, they already give away a little bit what they're doing with their alphas. They automate them, they run them on high and mid-frequency time horizons, not so much on longer frequency ones. In addition, many of these alphas are ephemeral and their universe is very fluid, basically meaning when they use these alphas, they usually have a system that selects them and then runs them. And when they realize, oh, this alpha isn't performing in live trading as well as it should, it's usually taken out and replaced by something else. So hence the fluidity. It takes quantitatively sophisticated, technological, well-endowed, and ever-adapting trading operations to mine hundreds of thousands, millions, even billions of alphas and combine them into unified mega alpha. It's true that it's definitely, it takes quite a lot of technology to do this. However, it is possible to, at least to some extent, to actually do this with a smaller operation as well. So it's not like that you categorically need this huge computing power. And then finally, which is then traded with an added bonus of sizable savings on execution costs due to automatic internal crossing of trades. So the interesting thing with the alpha combination is that instead of running them all individually, when you actually run them all, or you mathematically combine them, instead of you may have many cases, very conflicting signals and hence conflicting trades. And if you combine them, what it does is it basically internally, nets out all the different signals and then ends up with like one big trading signal, which is what you act upon. And that means by doing that, you can actually reduce your execution costs enormously instead of trading them all separately, which costs you very dearly, especially when the turnover of your strategies is really high. So again, here was the link, and I saw someone has already posted that in the chat. Thanks, Trung, for doing that. Now, this concludes my talk about this paper, and yeah, I would love to see some of you asking a few questions because that's usually the interesting part. And there's already a question here. How long on average an alpha produce positive results? How often does one need to come up with a new alpha? That's an impossible question to answer, Trung, because what often happens is with a lot of these alphas, they come in and out of relevance. So they often they do well and then it disappears, maybe for a few months or a few years or even a few days, and then they come back. And so some alphas have lasted for 30 years and they're still ongoing. So if you ask, for example, trend followers, so there's a couple of trend following podcasts out there, and you will find that trend followers often say, well, the signals haven't really changed for 30 years, or they have been updated a little bit. And yeah, Top Traders Unplugged. It's thanks, Benjamin. That's the one I was thinking of. In fact, when you ask these guys, they say, well, I mean, no, I'm a bit too categorical here, but a lot of them say, well, we use really basic signals and we haven't changed them for the last 2 decades, and that's how it works. So, and that's actually a fair point. If you find something that really works, why change it? And if it works for them, absolutely, and it really depends where you're coming from. If you're more someone that is really into computing, then you probably have no idea what these signals could be because you don't have the economic understanding, but you could still do something on the mathematical side as it's presented in this paper here. So I think the good thing is that there is room for everyone in the market, and either way, you can do some interesting things. So, any other questions? And please feel free.
Yeah, I got a quick question. This was great, by the way. So as a kind of a newcomer into this field, and especially like I'm still in college, so getting like data that's clean is definitely one of the biggest challenges that I face. Are there any places you would recommend or to look for data beside? There's obviously like Yahoo Finance, or there's APIs or libraries that give you basic price data, but how can we get better, cleaner data that's more in depth as like a retail person, not in a institution?
One thing I can tell you is that there is no clean data. Data are really far from clean in general, and and actually, what clean what does clean mean? It's actually incredibly difficult to define that. The only clean data, clean quote unquote data that you can get is if you plug into an exchange and literally get the PCAPs, the package capture, like from the, like as they arrive, and then effectively what you need to do is transform them yourself. But of course, as a retail trader, you can't do that. Now, there is, as AN said, CyberSyn has free data in partnership with Data Envo. I have never heard of them. Now, for my own purposes, and sometimes, I used to also be on retail side and so on, and one of the things that I use a lot is Y-Finance. So it's basically a Python package that scrapes Yahoo Finance data from the website. And it turns out when you compare them, for example, with data, let's say from interactive brokers or so, the Y-Finance data are not bad. They are reasonably clean, if you will. So they're definitely good enough to work with them if you know some of the shortcomings and understand them. So, obviously the CyberSyn looks like an interesting platform as well. I haven't actually checked it out yet. But if you really want to get started and you have nowhere to go for there, Y-Finance is a good one. It also has futures contracts and especially continuous future contracts and options. So there's quite a variety of things you can get. And I think it's also got some fundamental data, and they're very, very easy to download. So just use the Y-Finance package in Python. And yeah, a lot of what I do actually does this. Eric says there's polygon.io. And of course there is, and we've got, I've seen we've got the guys here from Norgate. There's Norgate data. And Norgate is definitely a really, really good platform as well, which a lot of people that I know here use. And it comes at a very reasonable price. And one of the really good things is it's highly curated. So they're really putting a lot of effort into actually cleaning the data, making sure it's all good. So I think it's worth checking them out. And by the way, I'm not affiliated with them, but I know of them, but I'm not affiliated with them.
Can you repeat that name? I didn't catch it. Sorry.
It's called Norgate, Norgate, Norgate. I'll just put it in the chat.
So I'm Richard Dale from Norgate Data here. So
yeah, I saw you, Richard. That's why I thought, like, yeah, I should mention you because of course you pop up a lot, especially in the space of like semi-professional. Also, a lot of retail traders use your data, right?
Our offerings are targeted at the retail space or the sort of semi-pro level. So, but just a quick comment. One of the big problems with most of the free sources out there is that it's a survivorship bias. You won't get the delisted stocks. You'll get a very limited set of events. And once you you do a test on, say, Russell 3000, big universe of stocks. It's obviously around 3,000 at the moment. You go back to 1990, and that universe is now 12,000. So So there's a lot of stocks in there that have come and gone. All your Enrons, Yahoo, the original Yahoo, all that sort of stuff. So
hey, Richard, while you're here, if I could put you right on the spot, how would you like to host an event like this and do a how-to of just how to get started getting data? Because I would say every single person who gets started kind of crashes on the rocks of getting data, and I think it'd be awesome if we could just show people how to do it with Norgate.
Love
also
to do
not
that.
Affiliated. Also not affiliated.
I did a fair bit of integration work with the zipline code to bring our data into.
Excellent.
Here we go.
Your environment.
Awesome.
So, but I'd love to do something. We'll
great. I'll DM you and follow up.
Yeah,
awesome.
And Tom, Trung had a question for you.
Okay. Yeah. What? Can you please? There was another question.
Yeah, Trung, do you want to chime in?
Yeah, I'm new to the field and I'm just curious about trading in general. And I'm reading books by Dr. Ernest Chan. So, what's your opinion on his books? Is a beginner?
Yeah, it's interesting, Trung. I actually started with Ernie's books as well. I think it's a good starting point. So especially his first one, the yellow, what's it called? Quantitative trading also. So I think it's a really good book. I think you need to, like with any of those books, you always need to take what people say in there with a pinch of salt. They're not necessarily always giving you the full story, and so I highly rate Ernie's books, and actually they got me, or at least to some extent they got me started. But what I would also say is, and I say this every single time someone new asks me, is instead of reading the book, as soon as you read anything in any book or any paper, sit down and write the code for it. Like literally, even if you find it really difficult, sit down and write some Python code. They're basically trying to model what they've done or trying to build something equivalent. There is nothing else as powerful and as good as actually sitting down and writing your own code and building your own platforms. I've once seen this lady, and she said she had a website called Building 100 Websites in 100 Days. So every day she built like a new website, and she basically documented how she started to learn website building just by doing it and just by building one each new day. And maybe if you really want to get good at this, you should maybe build like one new trading strategy from scratch every single day or every single week or something like that. And that's, in my opinion, the best way to learn. So, and what's actually really interesting is when you start doing that, then the books become more of a supplementary thing, that you can refer to when you don't know something, rather than reading the book thinking, oh, what they say is all is the gospel, and then trying to do that. Actually start rather from your own code, and I think this is actually a lot better.
Yeah, awesome. I would do that.
Great.
I'm actually learning more about GAN too, generative AI, and try to make synthesis like
Now one thing I would recommend though is, if you ask me, and obviously again, this is just my personal opinion, is not to start with AI, because there's a few complexities in AI that actually not really easily translate into financial markets, and I could give a whole talk on that, but it's actually, in my opinion, it's easier if you actually start a little bit more basic and see what you can find and really understand that, rather than going with the full AI suit. Because I've seen I mean, I talk to a lot of people, and the one thing I see over and over again is all these data scientists that just try to fire an AI onto financial data, and they never got anywhere. Like I would say 99.9% of them, because they hadn't actually really understood the basics of trading and financial markets. So it's just my opinion, obviously, and but I would highly recommend that.
Yeah, that's a good point. Yeah, I think Dr. Chance in some of his podcasts also mentioned that machine learning is not a way to go.
Well, it's good as a tool, but you know what a lot of the people from data science and programming think is that this is they worship the power of AI, and I think this is just plainly wrong. It's a tool to use to get you somewhere, but it's a tool that can sit on top of all your other understanding on the financial markets, but not as a means by itself. That's my opinion. So make whatever you want from that.
Thank you so much. Yeah.
All right. Great. Are there any more questions?
I had one.
Oh yeah. Maybe you can just state it. That would be good.
Oh yeah. So I see in Alpha 53, and I've seen this actually a lot. There's a formula where it's like close minus low minus high minus close divided by close minus low. I've seen that kind of variation of close minus low or something of like that. Is there some sort of fundamental meaning behind it, or are they just subtracting one by the other?
No, there is. Well, there isn't necessarily fundamental meaning behind it from in that formula, right? But when you actually look at it, there is some. It's basically the idea of candlesticks, and so if you work in some firms and you use candlesticks, you basically get sacked straight away. However, some people are very successful in trading candlesticks, and sometimes it's useful in a sense because, for example, if you say, well, if let's say the open and the close price are very close together, but then you have an extreme high and low in between, that means that the market is just really undecided. Whereas if you have, if your high and your low are equal to the open and close prices, that means that you usually have a very strong trend and a very strong opinion. So like those candlesticks can give you definitely some interesting information and some in terms of market psychology and so on, and some other things. And so that's really what those things are. And now clearly you can combine them. You have like one candlestick which is just open, high, low, close, but then if you have three, then it becomes actually pretty complex. There's literally thousands of different ways you can combine those patterns, and some of them actually give you reasonably statistically significant information going forward. So yeah, so that's, I guess that's my answer in a nutshell. Hope that makes sense. Cool. All right. Anyone else? Looks like
sorry, what?
Like any more questions?
Last thing,
Sure.
I think we actually had a bit of a chat about this in Sydney at some stage, but a lot of these alphas are showing sort of absolute values of the trading prices, and obviously ranking a $200 stock versus a $5 stock is all a bit silly. Do you think
not necessarily.
some sort of normalization needs to happen with these alphas to perhaps make them a little bit more relevant?
Yeah, I mean, in the first instance, it can be a bit silly to rank them just purely based on the prices, and yeah, normalizing them may be a good idea. however, it's not always as silly as it seems, because often when you do that, you know, you have let's say you have these very expensive stocks, right? That they're quite unattainable for a lot of retail investors, and so the dynamics of those can be different than the dynamics of very cheap stocks, you know, because a lot more retail people would actually come in and trade them. And so while you're right, it may seem silly at first, it's not necessarily all that silly, because
there's some information value inside just the absolute stock price. Yeah, that's true.
Yes, and then you make some assumptions on the dynamics of those stocks, which can be quite different, you know, for say penny stocks and like some hundreds of dollars ones. So I would say, well, yeah, yes and no. I mean, it you know, and if it's really that silly, you know, that alpha obviously wouldn't survive. So you could just go, okay, I just discard that. And yeah, it's funny. Sometimes things do look quite silly. And again, I can go back to my last paper presentation, where basically the idea that you completely overfit a model and that would still perform well out of sample, it seems really silly. But in fact, more and more I see confirmation of this in my own work. And so you know, it's good not to discard certain things outright. That's one lesson I had to learn to some extent the hard way. And yeah, it really depends. So Force, you just said something. Can you say it out loud again? With the you say, I started looking for pro quants to show them my backtester. Oh yeah,
there was a question up above from Anne, just how I got started to launch Quantopian. And first I read Ernie's book, and I just, for some reason, backtesting really fascinated me. So I just really wanted to write a backtester. So that's the first thing I did. It was super simple. It was basically a glorified for loop. And then because I had something to show, I felt comfortable reaching out to people and asking if they wanted to see my little baby backtester. And a lot of people did. And while they couldn't tell me what they did in their day jobs, they were very happy to critique my backtester. So
yeah,
that was a great education.
I can only second that. I've had exactly the same experiences. What is funny is actually for us that I still have the code of my very first backtester, which basically ran. It took probably about half an hour to do what I can now do in less than 10 milliseconds. So I have to say, like, there was a good reason why people shredded what I've been doing. and it's a big learning process, obviously. So I absolutely second your experience, and that's just the way it normally goes. That's just like how we evolve, right? We start with something we think is good, and then we just get better at doing it. And yeah, it's just learning by doing, ultimately.
I think Atek is trying to ask a question. He politely raised his hand.
Yeah, go for it. Question? Well, who? I can't see who raised his hand. So
these might be inadvertent. Also, Joshua Thomas has his hand up.
Okay.
I had a question that I asked earlier. Can everyone hear me?
Yes.
Yeah, can hear you.
Sure. So going back to the AI and looking for alpha, are there any alphas in the paper that were generated from AI, or was it all just found by humans and just back tested?
You don't need an AI per se to generate these alphas. You can actually, build something that isn't an AI that can generate this stuff. So people talk a lot about AI, but they forget that, it's not always the best tool for the job. And So in order to generate this, what you need is basically a kind of a tree structure, I suppose. And you know, there's many ways to do it, but you don't need AI for it per se. You could do it in different ways.
Right.
There's different techniques to do it. So, like AI would probably be the last thing I would use as a tool of choice to do that, because it's probably far too slow to actually really generate some meaningful numbers.
Okay.
I suspect.
I mean, me as a trader, I mean, I just look at candlestick patterns and just market price action. So,
yeah,
I just wanted to know if there was anything, or was it just kind of the same method that these alphas were published at, just coming up with the formula and back testing and.
Yeah, I mean, they're clearly randomly generated, or at least they come from a random generator originally, and they may have been selected after that. So there may have been a selection of those after they have been randomly generated. Because if you do that, and Richard pointed that out already, that you know some of it just simply doesn't make any sense. So you need, you know, once you get through the generation stage, you need something that also, you know, at least puts a few boundaries on what actually makes sense. And that's where it gets tricky. Now in AI, it's definitely not, or I don't think there is much of an AI right now that can do that. I can see how you can train one to do it, but yeah, it's probably kind of inefficient because you know there's easier ways to do that. So yeah, and if you are a trader and using patterns and stuff, you probably you probably need to teach to do a bit of programming. It's a bit of a barrier to entry at first to get something like this. But I would say that for most people, their programming skills, that would be quite a barrier to entry to actually step into this straight away. There's probably a few ways to simplify that process and make it a bit easier. Yeah, I mean, yeah, it depends really.
Okay. No, I have experience with programming. My day job is in IT, so.
Oh, great, awesome.
But
yeah,
I think it's the intuitive understanding of how these how this works.
I think there isn't really much of an intuition behind that. It's really all just purely statistical. So I would say if you try, it's a bit like quantum physics also. You can't, like, it's impossible to get an intuitive understanding of it. You just have to really just follow the maths and just accept it. You suck it up and hope it gives you some good results. And of course, like in quantum physics, the results are amazing, even though no one really understands why it is the way it is. But if it gives you good results, you use it regardless, right? It's true for physics. It's probably also, at least to some extent, true in quantitative trading. Of course, by the way, that there's probably a lot of people that would absolutely crush my argument here. So again, don't take my word as gospel. Anyone else? Any more questions?
Thank you.
Sure. So if there's no more questions, we're already 1 hour and 20 minutes in. Maybe, Forrest, what do you think we concluded for today?
Yeah, I think this is a nice stopping point. And Tom, this was such a pleasure. I really enjoyed tonight's presentation, and I really also appreciate all the questions. This was like great interaction after the presentation. So thank you to everyone.
Yeah. Thanks to everyone. Have a lovely day and happy trading.